In January 2026, the Bank of England released a number: 61,013. That was how many mortgage approvals went through in December 2025. Sounds like a lot, doesn't it? But here's the thing. It was the lowest figure in 18 months. And that's where this story gets properly interesting. Because at the exact same time, house prices across Britain were still going up. Nationwide said prices rose. Halifax said the same. The papers ran with it. Market stable. Recovery on track. But if everything's so brilliant, why aren't people actually buying? This is the contradiction sitting at the heart of the UK housing market right now. The price tag says one thing. The behavior of actual buyers says something completely different. And when those two things stop matching up, that's when you need to pay attention. This isn't a crash. Let's be clear about that straight away. But it's not fine either. It's something in between. Something quieter. Something that creeps up on you. And by the time most people clock what's happening, the ground has already shifted. So let's break down what's really going on. What the numbers actually show. Who's feeling the pressure. And why this matters whether you're trying to buy your first gaff, sell up, or just figure out where this country's housing market is actually heading. Because the official story and the real story aren't quite matching up anymore. And that gap is where the trouble lives. Right, let's get into the actual figures. On the 30th of January, 2026, the Bank of England dropped its money and credit report. This is proper official data. The real stuff. Not surveys, not vibes, not what some bloke on Twitter reckons. This is the central bank telling us exactly how much lending is happening across the country. And buried in that report was the mortgage approval number. 61,013 approvals for home purchases in December. Now, the market was expecting around 64,800. So the actual figure came in nearly 4,000 lower than forecast. That's not a rounding error. That's a proper miss. But here's what most people don't realize. December wasn't a one-off. It wasn't just a dodgy month. Look back across the whole of 2025. Mortgage approvals were soft the entire year. October dipped when the budget uncertainty kicked in. November dropped again. December confirmed the pattern. 3 months in a row. All heading the wrong direction. And this matters more than most people think. Here's why. Mortgage approvals are what economists call a forward-looking indicator. When someone gets approved for a mortgage, they haven't bought a house yet. They're about to. So when approvals fall, it's not telling us about the past. It's telling us about the next few months. Fewer approvals today means fewer actual sales tomorrow. Think of it like this. The housing market is a machine. Mortgage approvals are the fuel going into that machine. Right now, the fuel gauge is dropping. The engine's still running. But it's running on less. And if that continues, eventually you notice. Transactions slow down. Estate agents get quieter. Sellers wait longer. The effects take time to show up. But they do show up. That's what makes this data so important. It's not telling us where we've been. It's warning us where we might be heading. And right now, the warning light is flickering amber. Not red. Not yet. But amber is still amber. But here's where the story takes a strange turn. Because while mortgage approvals were falling, house prices weren't. Nationwide's January 2026 data showed annual house price growth of about 1%. That's not exactly booming. But it's still positive. Prices are still creeping upward. Halifax reported similar figures. Modest growth. Nothing dramatic either way. So on the surface, the market looks alright. Prices up. Headlines positive. Nothing to worry about. Except the people who actually measure demand are seeing something different. This is the disconnect that nobody's really explaining properly. House prices and mortgage approvals are supposed to move together. When more people want to buy, prices go up. When demand drops, prices eventually follow. That's how it's meant to work. But right now, they're going in opposite directions. Prices gently rising. Approvals falling to 18-month lows. How does that make sense? Here's the explanation most people miss. House prices are a lagging indicator. They reflect deals that were agreed weeks or months ago. The price you see in today's index is based on sales that completed recently. But those sales were set in motion much earlier. Back when approvals were higher. Back when confidence was different. So current prices are essentially showing us old news. They're the echo of decisions made before the weakness kicked in. Mortgage approvals, on the other hand, are showing us what's happening right now. And right now, buyers are hesitating. This is the gap that should worry you. The headlines say stability. The actual behavior of actual people says caution. One of those things is going to be right. And eventually, they'll have to align. Either approvals recover and justify the prices, or prices adjust to reflect the weaker demand. There's no third option. The market can't stay disconnected forever. Something has to give. And that's the tension sitting underneath everything right now. On paper, the UK housing market looks fine. In reality, the foundations are softer than they appear. So what's actually stopping people from buying? If you talk to anyone who's tried to get on the property ladder recently, you'll hear the same themes coming up again and again. It's not one thing. It's a combination. A proper perfect storm of pressures all hitting at once. Let's break them down. First up, the end of temporary tax relief. Earlier in 2025, the government adjusted stamp duty thresholds. First-time buyers got a bit more breathing room. Lower-value properties got some relief. And that helped. It gave people a reason to crack on and get their purchases sorted before the deadline. But those reliefs have now ended. The urgency is gone. The incentive to move quickly has disappeared. And when you remove urgency from a market where people are already stretched, they wait. That's pressure point number one. Second, fiscal uncertainty. The autumn budget brought changes. Some expected, some not. Property taxes at the higher end got tweaked. There was talk of more adjustments coming. And when people don't know what the rules are going to be next year, they freeze. Nobody wants to buy a house and then find out the tax situation has changed 3 months later. So buyers who could afford to wait decided to do exactly that. Wait and see. That's pressure point number two. Third, and this is the big one, affordability. Interest rates have come down a bit from their peaks. That's true. But for most ordinary punters trying to buy a home, borrowing is still expensive. Monthly mortgage payments eat up a massive chunk of household income. Even if house prices aren't rising quickly, they're not falling either. So first-time buyers are stuck. Prices that feel out of reach. Borrowing costs that stretch the budget. Deposits that take years to save. The maths just doesn't work for a lot of people. And when the maths doesn't work, people step back. That's pressure point number three. Now multiply that hesitation across thousands of households. Thousands of people thinking the same thing. Maybe next year. Let's see what happens with rates. We're not quite ready. All that hesitation, all that caution, all that waiting. It shows up in one place. Falling mortgage approvals. The data isn't abstract. It's the sum of real decisions by real people. People who wanted to buy a home but looked at the numbers and thought, not yet. And right now, there are more of those people than there were 18 months ago. That's the reality underneath the statistics. Not a crisis. But not confidence either. Something in between. Something that feels like waiting for the other shoe to drop. But the effects don't stop with buyers. When mortgage approvals fall, the impact spreads outward like ripples in a pond. And some of those ripples hit places you might not expect. Let's start with estate agents. Fewer mortgage approvals means fewer transactions. Fewer transactions means fewer sales. Fewer sales means less commission. Estate agents don't get paid unless deals complete. That's how the business works. So when the market slows down, their income drops. Simple as that. Some agencies can ride it out. They've got reserves. They've seen slow patches before. But smaller operations? Independent agents in quieter towns? They're feeling the pinch right now. Longer listing times. Properties sitting on the market for weeks, months even. Sellers getting frustrated. Buyers making cheeky offers because they know the agent needs the deal. It's not a bloodbath. But it's not comfortable either. Next up, builders. House builders watch mortgage data like hawks. They have to. If demand is weakening, there's no point starting new developments. Why build houses if you're not sure people will buy them? So when approvals drop, planning applications slow down. Construction activity softens. Projects get delayed or scaled back. That means fewer jobs in construction. Less work for contractors. Smaller order books for building suppliers. The effects cascade through the whole sector. And here's something most people don't think about: consumer spending. When people move house, they spend money. New furniture. New appliances. Renovations. Decorating. The average house move triggers thousands of pounds of additional spending. That money flows into the economy. Shops, tradespeople, delivery companies. But when fewer people move, that spending disappears. It's invisible in the headlines. But it matters. Retailers notice. Service businesses notice. The housing market isn't just about houses. It's connected to everything. And then there's the banks. Lenders with big mortgage portfolios watch approval numbers very carefully. Fewer approvals means slower loan growth. That affects profits. It affects forecasts. Banks start thinking about risk differently. They might tighten criteria. They might adjust pricing. And if lenders get more cautious, that makes it even harder for buyers to get approved. Which makes approvals fall further. Which makes lenders more cautious. You see where this goes. It's a feedback loop. Not a dangerous one yet. But a real one. The housing market is an ecosystem. When one part weakens, the pressure spreads. Right now, the surface looks calm. The indices say prices are stable. But underneath, the current is weakening. And currents matter more than surfaces. Now, some of you might be thinking, isn't this just 2008 all over again? Fair question. Let's address it properly. The 2008 crash was a systemic crisis. Banks had lent recklessly. Mortgages were given to people who couldn't afford them. Financial products were built on dodgy foundations. When it collapsed, it took everything with it. Banks failed. Households were trapped with negative equity. The whole system nearly went under. That's not what's happening now. Let's be absolutely clear about that. Today's weakness is different. It's demand-side weakness. Buyers are cautious. Borrowing is expensive. Confidence is fragile. But banks aren't failing. Lending standards are much tighter than they were back then. Defaults aren't spiking. The system isn't breaking. This is a different kind of stress. Slower. Quieter. Harder to put a name on. It's not a cliff edge. It's a gentle slope. And that's what makes it tricky. Because when things fall off a cliff, everyone notices. Everyone reacts. But when things slide slowly, people adjust. They normalize it. They stop paying attention. And by the time the slow slide becomes obvious, it's been going on for ages. That's the risk here. Not a crash. But a long, slow grind. Affordability staying stretched. Transactions staying low. Confidence staying fragile. Year after year. Some industry voices are more optimistic. Simon Gammon of Knight Frank pointed to early signs of renewed buyer interest in January 2026. Maybe December was just a blip. Seasonal factors. Timing around the budget. That's possible. Melanie Spencer of Target Group made similar points. The December drop wasn't entirely surprising, she said. Late budget timing. Seasonal lull. These are reasonable takes. But they are also tentative. Nobody knows for certain whether January will bounce back. Nobody knows if 2026 will see sustained recovery. The honest answer is, we're watching and waiting. What we can say is this. The gap between headline price growth and underlying demand is real. Until approvals recover properly, the market's foundations remain softer than they look. And that's not fear-mongering. That's just reading the data for what it actually shows. Prices up slightly. Demand down notably. Something has to give. The only question is what, and when. So where does this leave actual people trying to navigate this market? Let's break it down by who you are. If you're a first-time buyer, the data suggests patience might pay off. Not because prices are about to crash. That's not what the evidence shows. But because the pressure on sellers is building. Transactions are slower. Properties are sitting longer. That changes the negotiating dynamic. Sellers who've been waiting months might be more open to offers. Estate agents who need deals might push harder for compromise. You're not powerless. Even in a weird market, information is leverage. Watch the mortgage rates. Watch the approval numbers. Don't let FOMO push you into a deal that doesn't work financially. The maths has to make sense. If it doesn't, waiting isn't weakness. It's common sense. If you're trying to sell, be realistic about timelines. This isn't a market where properties fly off in a week. Pricing matters more than ever. Overpriced listings will sit. And the longer they sit, the worse they look. Talk to your agent about what's actually moving in your area. Not what sold 6 months ago. What's completing now. Flexibility is your friend. If you're a homeowner watching your mortgage fix end, this is where it gets serious. Rates have come down a bit. But they're still higher than the deals people locked in a few years ago. When your fix ends, the payment shock can be substantial. Budget for it now. Don't wait until the letter arrives. Speak to a broker early. Understand your options. Switching deals takes time. And if you're just trying to understand the market, keep watching the mortgage approval data. It's the most forward-looking indicator we have. It tells you what's coming, not what's already happened. When approvals start recovering properly, that's a real signal. Until then, the market is in a holding pattern. Not falling apart. But not firing on all cylinders either. That's where we are. A market that looks stable from a distance but feels uncertain up close. A market where the official story and the lived experience don't quite match. A market where quiet pressure builds in places most people aren't watching. This isn't the end of the UK housing story. But it might be the moment when the story starts to change. Not with a bang. Not with a crash. Just with a slow, steady shift that most people won't notice until they look back and realize it was already happening. If you're watching this market closely, or living through it, we want to hear from you. Drop a comment below. Tell us what you're seeing in your area. Whether you're buying, selling, waiting, or just trying to make sense of it all. And if you want more calm, grounded breakdowns of what's really happening in UK property, subscribe to the channel. Because this story isn't finished. And the next chapter is already being written.